The IRS is coming after a particular tax loophole that we're going to discuss in today's video. An annual notice was just released telling taxpayers to be aware of promoters peddling bogus tax schemes. Well, one of the schemes on this list is a particular loophole that I see often marketed to retirees right here on YouTube as a way to supercharge your Roth conversion strategy. Here's how this strategy has been marketed to retirees. Say you're someone who has a tax problem due to having way too much wealth in tax-deferred accounts. And down the road, you see that required minimum distributions, that forced withdrawal that you're going to have later in retirement, is so large that it's going to force you into specific tax hurdles. And so performing Roth conversions may be necessary to save on taxes. Well, it's typically only prudent to Roth convert a few $100,000 each year at most. And so for some, this might be Roth converting for the better part of a decade. Well, good news. There's a secret tax strategy that will allow you to supercharge conversions and perform large conversions all in 1 year, or at least that's how this strategy is marketed. And because of this strategy, you can get a massive tax deduction and convert, let's say, $1 million in 1 year for a fraction of the tax cost because of that massive deduction. And so this strategy hinges on something called a conservation easement. Now, a conservation easement is a viable tax deduction if used properly, and the intended use is shown on the screen. So let's say that you have a $100,000 plot of land in Montana. Well, you can put that land inside of a conservation easement. You agree to maintain certain objectives like keeping clean water, keeping it undeveloped, etc. In exchange, you get a tax deduction for the fair market value of that property. And so in this case, you'd lock that $100,000 property inside of a conservation easement, and you'd gain a $100,000 tax deduction for doing so. Now, for 99% of people, this isn't a tax saving strategy at all and really can't help with Roth conversions. If you went out and bought a $100,000 piece of land and put it inside of a conservation easement just to get a $100,000 tax deduction, that would end up costing you money, not saving you money. You'd have to spend $100,000 to get a $100,000 tax deduction, but a deduction only saves you on a percentage basis. At, let's say, a 25% tax rate, you spend $100,000 to gain a $25,000 tax savings. But really, you lost $75,000. You paid $100,000 to get a $25,000 benefit. That really doesn't make sense if you don't already have that property and we're already planning on putting it inside of that easement. Well, here's where this strategy gets abused and why the IRS is clamping down on this avoidance technique. Rather than buying a piece of land yourself, you go through a syndicate. This is a group of people that is typically headed by an attorney. Now, it typically costs you anywhere from $10,000 to $50,000 to get inside of these syndicates. And basically what the syndicate will do is they'll go out and buy a massive tract of land. Now, your share of the land and cost to you might still only be $100,000. But then this syndicate will go out and hire a third-party appraiser and pay them to essentially inflate the value of your share by 3 to 6 times. So your actual share of the property is $100,000, but your perceived value when you lock this inside of a conservation easement might be $600,000. And so anyone can see how this would be problematic, and this is exactly why the IRS has been clamping down on these schemes heavily. They included it in their annual Dirty Dozen campaign where they discuss a number of bogus tax schemes, and they also amended legislation recently to clamp down further on this loophole. But is this strategy worth the risk? After all, it's a pretty big tax deduction. We'll know that the risk is quite high here as well, especially if the IRS is clamping down further. First off, there is a $10,000 to $50,000 cost to get into the syndicate. That is completely lost if this strategy doesn't pan out. Then there is the cost to the property. Now, you may still get a deduction based on the actual fair market value, your actual share, but know that the inflated value, any benefit you get from that, well, that will basically be reversed. You will also certainly get audited if you have this on your tax return, after all, because a lot of these type of deductions are being flagged right now by the IRS. But now here is where the penalties really start to hurt you. There is a 40% penalty based on something called the gross valuation misstatement. So let's say that you inflate a $50,000 piece of land up to $350,000. The gross misrepresentation is $300,000. Let's say at a tax rate of 30%, you illegally avoided $90,000 in taxes. So you're obviously going to have to pay back that $90,000 in taxes, but you're also going to have a penalty of 40% of that amount. In this case, that would be $36,000 in additional penalties. But that's only if the IRS deems this an accuracy penalty rather than a fraud penalty. If the IRS deems this as blatant fraud, they may adjust that accuracy penalty into a civil penalty, and you may now owe 75% of that misrepresentation rather than just 40%. Again, my recommendation, avoid these strategies altogether. If they're too good to be true, they likely are, and instead focus on fully legal tax saving strategies. If you're currently in your 60s, I have 8 tax tips that you can use that can translate to 6-figure tax savings if you use them properly. Click on this video to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching.